Let's start with the basics. What is economics? Economics is often defined as a study of how society uses scarce resources to produce valuable commodities and distribute them among different people. It's about understanding the choices individuals, businesses, governments, and societies make as they confront scarcity and the implication of these choices. Why is this important for understanding market dynamics? Well, economics provide us with the tools to interpret market trends, predict changes, and make informed decisions. These include supply and demand, inflation, interest rate, and market indicators. Each of these play a crucial role in shaping the market's behavior. Let's explore a concept that significantly influences both financial markets and the world of cryptocurrencies: inflation. Understanding inflation is key to comprehending why markets move the way they do. Ever noticed how the cost of a cup of coffee seems to creep up year after year? That, my friends, is inflation in action. Inflation is like a quiet background music that gradually gets louder. It's the rate at which the price for a thing we buy, from groceries to gadgets, increases over time. It's why a dollar today might not buy as much as it did 10 years ago. Imagine if we could put a price tag on everything you bought in a month, from your Netflix subscription to your favorite sneakers. Economists do the same thing. They track a basket of goods and services over time to calculate the inflation rate. Normally, inflation is like a gentle ride on a merry-go-round, predictable and steady, but sometimes it's more like a roller coaster, with price skyrocketing or plummeting. Remember Zimbabwe in the late 2000s? That was a wild ride no one wanted a ticket for. Let's bridge this to our world of cryptocurrency. Unlike traditional currencies, where more money can be printed, many cryptocurrencies have a fixed supply. Think Bitcoin. Its capped quantity is like having only a limited number of golden tickets in the world, making it inherently resistant to inflation. Inflation isn't just an economic term. It affects how much you pay for your morning latte, how much your salary is worth, and even the value of your investments. And in the crypto world, it plays a unique role in shaping investors' behavior. Now let's look at tools that shape the economy. Interest rate. So what exactly are interest rates? In simple terms, they are the cost of borrowing money. When you take a loan, you pay back more than you borrowed. The extra is interest. It's like renting money. The rent you pay is the interest. Central banks are like puppet masters of the economy. They adjust interest rate to either encourage spending and investing when the economy is slow, or to cool it down when it's overheating. This balance act is crucial for economic stability. Now, you might wonder, what do interest rates have to do with cryptocurrencies? A lot, actually. In a low interest rate environment, investors often seek higher returns elsewhere, leading to many alternative investments like Bitcoin or Ethereum. Interest rates aren't just local affairs, they have global ramifications. A change in a rate by a major central bank, like the US Federal Reserve, can send ripples across global markets, affecting everything from stock prices to the value of cryptocurrencies.
Good afternoon.
Now let's unravel the intricate relationship between stock market and economic sentiment. Have you ever wondered how the highs and the lows of the stock markets reflect what's happening in the economy? Think of the stock market as the pulse of the economy. It's a living, breathing entity that reflects to both the current economic climate and the expectations about the future. When investors are optimistic about economic prospects, the market often goes up. When they're pessimistic, it can take a downturn. Economic sentiment is like the mood of the marketplace. It's shaped by a variety of factors, from employment rates to political stability and even global events. The sentiment is a powerful force, influencing investment decisions and stock prices. Interestingly, stock markets and cryptos are often considered leading indicators. They can signal changes in the economy before they are reflected in other economic data. For example, a consistent rise in stock prices might indicate economic growth, while a persistent fall could signal downturn. Now, in our world of cryptocurrencies, the stock market sentiment can have ripple effects. Positive economic sentiment might lead to more risk-taking and investment in crypto, while negative sentiment might see investors retreating to more traditional assets. Let's take a real-world example. Consider how the announcement of a new government policy or change in interest rate can cause an immediate reaction in the stock market. These reactions are investors interpreting the news and the speculation on its economic impact. Coincident indicators often use a snapshot of the economy's current health. Payroll employment data, for instance, indicate the strength of the job market, influencing consumer spending and ultimately stock market trends. We also have leading indicators like GDP and inflation rates, which confirm trends after they've occurred. While they're retrospective, they're crucial for understanding the impact of economic policies and events on stock market. Another important thing is liquidity. Simply put, liquidity refers to how quickly and easily an asset can be bought or sold in the market without affecting its price. High liquidity means you can quickly convert assets to cash, akin to turning a tap and getting a steady flow of water. Liquidity is vital for the smooth functioning of financial markets. It allows for efficient price and discovery and enables investors to enter and exit positions with ease. In a highly liquid market, you can sell your assets fast without having to slash the price. Low liquidity can lead to high volatility, where asset prices can swing widely. This is particularly evident in the cryptocurrency market, where liquidity can vary significantly across different coins and exchanges. Central banks implement quantitative easing by creating money electronically. They use this money to buy government bonds and other financial assets from banks and financial institutions. When central banks buy these assets, they increase the amount of reserve that the banks hold. This means banks have more money available to lend to businesses and consumers. By buying up government bonds, central banks push down the yields on these bonds. Lower bond yields often lead to lower interest rates across the economy, making borrowing cheaper. This can encourage both businesses and consumers to take on more debt, effectively increasing the amounts of money circulating in the economy. With more reserves, banks can increase lending. This influx of capital into the market increases liquidity as more money is available for investments and spending. An increased money supply can also stimulate consumer spending, as consumers feel wealthier due to rising asset values like stocks or home prices. They are more likely to spend more, further boosting the economy activity and liquidity. While increasing money supply can stimulate the economic activity, it also carries the risk of inflation. If too much money chases too few goods, prices can rise. Excessive liquidity can lead to asset bubbles into too much money pours into the asset, like stocks or real estate, driving the prices beyond fundamental values. Relying on central banks' money printing for liquidity isn't always sustainable in the long term. Eventually, central banks may need to unwind these measures to prevent overheating in the economy.